Thank you very much, Paul. So as Paul said, I'm going to be looking at how the forecast yesterday compare first with what we knew back in November. The answer is not much has changed. But also to look back on the last decade. And it's really important to understand where we've been, what that history is, to understand what the pressures are going forward, and Carl's then going to talk about the risks for the next decade or so in the public finances. So just to take you back to March 2008, give you a bit of context. So Northern Rock had fallen, but Lehman Brothers was still afloat. There was set to be a slight global economic slowdown, but we thought that we didn't see a financial crisis on the horizon. And actually, Alistair Darling stood up and presented a pretty optimistic budget. Now, it's been about 10 years since then, and we've come a long way. So firstly, let me just talk about the change in the growth forecast yesterday. Some called the change between this November 2017 part of the economy and the March 2018 part an improvement in growth. And you'll see that by the end of the period, we're basically exactly where we expected back in November. Growth is set to be slightly faster over the next couple of years, but the OBR doesn't think that reflects the fact that the trend growth of the economy is going faster. It actually thinks it means the economy is moving above trend. So now let's put all of this in a longer run context. So between 1997 and 2007, growth was really pretty strong, but since then, it's been extremely weak. If we compare this March 2018 forecast with what was expected back in March 2008, when Alistair Darling said, because of the changes made by this government to entrench stability and increase the flexibility and resilience of our economy, I'm able to report that the British economy will continue to grow through this year and beyond. Well, clearly that's not quite what happened. And I think there are two very important points to look at here about the difference between that March 2018 line and that March 2008 line. First, let's just look in this year, 2017-18, and GDP is about 14% lower than what we might reasonably have expected. However, as I said, we don't think, or the OBR don't think that there's lots of spare capacity to be eaten up. We're not going to be catching up to this line. And actually, growth going forward is incredibly sluggish. And perhaps an even bigger difference between now and March 2008 is not just that we've had 10 years of terrible growth, but that going forwards we're just much more pessimistic. So this gap is actually getting bigger and is set to be about 20% by 2022-23 on current forecasts. So to put some numbers on this and to look at GDP per capita, that is GDP for every man, woman and child in the UK, if we compare a pretty long-running pre-crisis trend with what's happened since 2008, the gap in 2017-18 amounts to about almost £6,000 per person relative to what we might have reasonably have expected back in March 2008. Now, there are a couple of important things to point out about this number. Firstly, it's an average, so it's going to be worse for some people and better for others. And secondly, it's not just about personal incomes. It also reflects the government services, the public spending by government that we might have expected to be enjoying had the economy performed much better. And this gap's just getting bigger, so over £8,500 per person based on the latest forecast by 2022-23. So you may wonder if this very slow recovery in GDP per capita is just what we should expect when we have recessions. Is this just what tends to happen? And we can look at that by comparing this most recent recession to other recessions that have happened over the last century or so. So first, if we look at the three most recent recessions in the 1990s, the 80s and the 70s, you can see that all of these recessions bounced back quite quickly. But it's also the case that the fall during the recession was smaller in these periods. However, we can go back even further to the 1920s and the 1930s when the fall in GDP per capita was just as large, if not larger. And even then, the bounce back was stronger. So this recovery really has been historically extremely weak. So GDP per capita is now slightly above where it was in 2008. But that actually masks some differences because employment growth has done quite well. The employment rate is now actually 0.5 percentage points higher than it was at the start of 2008. However, earnings have done particularly badly. They're actually still below their 2007-8 level after accounting for inflation, and it's set to be several years until they actually regain that level. And because there have been these differences, because earnings growth has been quite weak while employment has recovered strongly, it means that some households have fared relatively better than others. So, for example, pensioners have fared better than those of working age. They're less reliant on wage income, and it's also the case that the private pensions of the newest pensioners have been growing. And pension benefits have also been protected, so the triple lock has been a big giveaway to pensioners over this period. Even within working age households, there are differences. Richer households tend to rely more on wage income, and that means that they've actually fared worse than those towards the bottom of the income distribution who more recently have benefited from these increases in employment. And that means that income inequality now is lower than it was in 2007. So if we look at household net income after accounting for inflation, if we look at the household at the 10th percentile, that is the household for whom only 10% of households have less income, the real terms growth over that period is almost 8%. But if we look at the 90th percentile, the household for whom only 10% of households have more income, the real income's actually fallen by around 0.5%. Okay, so what have I shown you so far? It really is hard to overstate how bad economic growth has been since 2008. National income now is 14% below the level implied by March 2008 forecasts, and it's been a remarkably slow recovery by historical standards. And yet, despite that, the OBR think that the economy is now above trends, and accordingly, the medium-term outlook is extremely sluggish. This effect on the economy has affected households, with median wages still below their 2008 level, and within that there have been some differences. So pensioners have fared slightly better, and income inequality has actually fallen. Now, so far I've been focusing on the effects of the financial crisis and subsequent weak growth on households, but it's also the case that it affects the public finances, because when the economy is smaller, that means we raise less in tax, and that leads to higher deficits. So I'm now going to focus a bit on what's happened to the public finances over the past decade or so. So firstly on borrowing, and this is what we were hoping for back in March 2008, with borrowing increasing slightly for a year or two, but then dropping down to just over 1% of national income. Now clearly that's not what happens, and around the financial crisis, borrowing exploded to around 10% of national income, and there's really been a lot of political attention, and indeed pretty much all of the fiscal news since 2010 has been about getting that deficit down. What happened yesterday? Well, there was a very, very slight improvement in the borrowing forecast, but it's still the case that while we are due to be getting back to the level of borrowing that we were planning in the March 2008 budget, around 1% of national income, we're getting there almost a decade later than initially planned, and having borrowed quite a lot in the meantime. Now, one thing to point out here is that, of course, after March 2008, we quite quickly realised that this forecast was going to be quite wrong. However, there have also been consistent forecast downgrades over the past few years. So if we look at, for example, the June 2010 forecast, we were expecting to reach a deficit of around 1% of national income in 2015-16. And just 2 years ago, in March 2016, we were due to be having a surplus by 2019-20, whereas in that same year, we're now due to be borrowing over £30 billion. So when we borrow a lot, that leads to higher national debt. So if we look at what's happened to debt since the 1990s, note that from the mid-2000s onwards, debt was steadily increasing as a share of national income, and it really explodes when we start to run those large deficits around the financial crisis. What changed yesterday? Well, again, a very slight reduction in the debt forecast because we're borrowing a little bit less. Now, one thing you may notice about this profile is that it looks like it's falling quite quickly towards the end of the forecast period. However, that's almost entirely down to Bank of England transactions. So if we exclude those, the profile is virtually flat over the forecast period. So debt at a much higher level than we had before and not falling particularly quickly. Now, it's important to say that we have maintained this level of debt and indeed higher before. So this is the highest level of debt as a share of national income since the mid-1960s. But we've maintained much higher levels, for example, during World War I and World War II. However, there is something slightly quite remarkable about the last decade or so. So we've added about 50% of GDP to debt. And now, that pace of increase, 50% in a decade, has only happened 4 times before since 1700. In the 1940s, the 1910s, the 1810s, and the 1780s. Now, I don't know how good all of your history is, but all of those were periods of wartime. So that means that the last 10 years, the financial crisis and its aftermath, is unprecedented in peacetime. So I now want to spend a little bit of time thinking about what it was that actually led to that large increase in the deficit, and in particular, whether it was reductions in tax receipts as a share of national income or increases in spending. So this top line here is total public sector spending, the bottom line, total public sector receipts, the difference is the deficit. So as we hit the financial crisis, there is a reduction in receipts as a share of national income, but it's spending that really jumps by quite a lot. Now, that isn't really due to a stimulus package announced by the government. Instead, it's because before the financial crisis, the government had some cash plans for the next few years, and those cash plans assumed that the economy was going to grow quite strongly. But when the economy turned out to be much smaller than hoped, that meant that those same cash plans were a much greater share of the economy. Or to put it another way, the financial crisis just gave us a much bigger stake relative to the size of our economy than we were planning. Now, what's happened since? Well, the bulk of deficit reduction has happened through spending rather than through higher taxes. But note that we're only now back to the spending share of national income that we were in 2007. All of that work, all of those tough cuts, just to get back to where we were before the crisis. Now, if we look at the consolidation still in the pipeline, you can see that there are set to be further reductions in spending, taking it below that 2007 level towards the end of the forecast periods. So to show that a slightly different way, I'm now going to think about the explicit policy measures announced by government since 2008 to try to reduce the deficit. I'm going to think about their total impact on the deficit in this year, 2017-18, relative to what we might have expected before the crisis. So firstly, there's been a net tax rise, and that reduces the deficit by about £29 billion this year, relative to if the government had not enacted any tax changes since 2008. There are large social security cuts, and then there are really quite large reductions or reining in of spending as a share of national income, both in terms of investment, but in particular in terms of day-to-day spending. If we look at what's still in the pipeline over the next few years, there's hardly any movement on net in terms of taxes over the next few years. There are quite a few welfare cuts still in the pipeline, and while investment spending is actually increasing as a share of national income over the next few years, there's more reining in of spending on day-to-day public services. Now, even if all of this is delivered by 2022-23, the government is still due to have a structural deficit worth £18 billion in today's terms. So that means that if the government wants to achieve its fiscal objective of eliminating the deficit by the mid-2020s, there's going to have to be a further £18 billion of consolidation, and as yet unallocated. We don't know where that will come from. That could come from spending cuts. It could come from tax rises. So that's the big picture. What about more specifically what's happened in terms of tax and spends? Well, you may be surprised to hear that there's actually been a net tax rise over the last 10 years, particularly because there have been some pretty well publicised tax cuts. For example, those above inflation increases in the personal allowance, large cuts in the rates of corporation tax, and that tradition of freezing fuel duties every April has become quite an expensive one, costing about £5.5 billion this year. However, there have actually been even larger tax rises overall, a lot of which happened some time ago. For example, increases in the rate of VAT to 20%, restrictions to pension tax relief for higher earners, the end of contracting out, and also a whole series of measures that can be loosely labelled as avoidance and evasion that are actually due to raise about £10 billion this year, though the costing is highly uncertain. So those are the tax changes, but a lot of the action has really been on the spending side. So welfare changes since 2010, we judge have saved about 1.2% of national income this year. And now that reflects large cuts to the generosity of tax credits and other working age benefits, while pensioners have been mostly protected. And in particular, the pension triple lock has been a very large giveaway over this period, despite the fact that when it was first introduced, it wasn't expected to cost very much at all. The other important thing to note on the welfare cuts is that there's still more in the pipeline, and Carl's going to talk a bit about the risks of those in just a moment. But deficit reduction really has been about departmental spending cuts, particularly cuts as a share of national income. So recall that I showed you that the state is just about the same size today as a share of national income as it was in 2007. However, because of the choices the government's made in terms of which areas to prioritise and which areas to cut, that means there's been quite a big change in the composition of the state over that period. So, for example, we're spending more on health, quite a lot more on overseas aid. Remember that the total is only about 0.7% of national income, so that's a really big increase. And also a lot more on the state pension. Compared to the state pension, other welfare has done much worse. And then we've also had cuts as a share of national income on, for example, defence and public order and safety. And that public order and safety reduction is really quite large given the fact that we weren't spending that much as a share of national income in the first place. So that's all of this as a share of national income, but of course part of the reason why we're only just back to that 2007 level is that GDP has grown particularly slowly over this period. So what does this look like in real terms? So I'm now going to look at real terms changes for different spending functions of government between 2007 and 2016. And you can loosely categorise this into three areas. Some areas that have been increased by around 20% in real terms over this period, for example, health and aid. Some areas that have been broadly frozen in real terms over that 9-year period, and some areas that have seen really pretty substantial cuts, for example, public order and safety. There are a couple of important things to note about these numbers. Firstly, that this period very much comes in two parts. Between 2007 and 2009, all of these areas were getting increases, and since then, a large number have had cuts. Look, for example, at the increase in health spending, about 20% in real terms over this period, but half of that came in the first 2 years. So since then, the health increases have been extremely small. And the other thing to note is that relative to what these departments or these spending areas were used to, these are very tight settlements indeed. So if we compare this 9-year period to the 9-year period previously, you'll see that all of these areas were getting much larger increases as in real terms over that previous period. So whereas the 2000s was a time of public spending increases, it's really been very restrained since then. Okay, so to summarise what I've shown, a decade of weak growth has affected living standards. Median wages are still below where they were in 2008. It's also led to large public finance problems, with the deficit ballooning to 10% of national income, debt more than doubling as a share of national income. In response, governments have enacted reasonably large net tax rises and welfare cuts, while public service spending has seen extremely large cuts. And importantly, there's still more austerity in the pipeline. Growth over the next few years is set to be very sluggish, and that puts us in a very challenging situation that Carl's going to talk more about now.